Part 1. The foundation, price versus volume. If you analyze financial markets purely by looking at price action, you are operating on incomplete information. Price tells you where the market has been. Volume tells you how much energy was spent to get it there. Most retail traders make the fatal mistake of treating price and volume as equal variables. They are not. Price is merely the advertising mechanism of the market. Its purpose is to movement test liquidity, to find levels where buyers and sellers agree to conduct business. Volume, on the other hand, is the actual business being conducted. It is the fuel, the institutional footprint, and the true measure of participation. To understand market structure at an institutional level, you must understand the relationship between cause and effect. Volume is the cause. Price movement is the effect. When a large institutional fund wants to accumulate 2 million shares of a stock, they cannot simply click a button and market buy. Doing so would destroy their average entry price by causing massive slippage. Instead, they must absorb sell-side liquidity slowly, methodically, and discreetly over time. That absorption process creates a footprint. Price might stay compressed in a tight range, but the volume bars beneath those candles tell an entirely different story. Let's look at a concrete real-world scenario to understand why trading price without volume is financial suicide. Consider two identical breakout candles on an S&P 500 intraday chart. Both candles moved $3 to the upside and closed near their highs above a key resistance level. To a retail price action trader, both setups look identical. Both signal a bullish breakout. Now, let's turn on volume. In scenario A, the $3 upward expansion occurs on 200% of the 20-period average volume. This indicates aggressive institutional participation. Market orders are absorbing limit orders at resistance. Buyers are willing to pay up, and smart money is validating the move. This is a true structural breakout. In scenario B, the exact same $3 upward expansion occurs on 40% of average volume. There is no aggressive institutional buying here. Price expanded simply because sell-side liquidity was thin at that moment, not because buyers were aggressive. It's a ghost town. What happens next in scenario B? The moment price encounters a normal block of institutional sell orders. The lack of buying backing the move causes an immediate aggressive reversal. The retail traders who bought the breakout are trapped. Price can lie to you. Low volume markups and artificial liquidity engineering happen daily on Wall Street, especially during light volume sessions like lunch hours or late August trading. Volume is the only metric on your screen that cannot be faked. Every contract filled, every share exchange requires actual capital deployment. If you want to read market structure accurately, you must stop looking at price in isolation. Price is the dynamic, volume is the truth behind it. Part 2. The mental model. Effort versus result. To systematically analyze price and volume, you need an objective mental framework. You do not need secondary lagging indicators like RSI or MACD. You need a foundational law of physics applied to order flow. That law is effort versus result, originally codified by Richard Wyckoff. In financial markets, effort is represented by volume, the total amount of capital or contracts executed, and result is represented by price progress, the spread of the candle and the net distance moved. Under normal market conditions, effort and result are directly proportional. High effort produces a large price move. Low effort produces a small price move. When this relationship breaks down, a structural anomaly occurs. It is within these anomalies that institutional footprint becomes visible. Let's break down the two conditions that govern this mental model. First is structural harmony, normal conditions. When a wide-range green candle forms on exceptionally heavy volume, effort matches result. Institutions are buying, price is advancing freely, and there is minimal opposing supply. Similarly, a wide-range red candle on heavy volume indicates aggressive institutional selling with little to no demand to stop it. When effort and result are in harmony, the prevailing trend is healthy and expected to continue.
Second is structural divergence, anomalies. The real edge lies in recognizing non-proportional relationships. Consider high effort with low result. Imagine a candle exhibiting the single highest volume bar of the entire trading session, yet the candle spread is extremely narrow, perhaps a small doji or a tight range spinning top. Ask yourself, if massive effort, capital, was expended, why did price fail to move? The answer is absorption. A dominant market participant is placing heavy passive limit orders on the opposite side of the aggressive flow. If aggressive retail traders are shorting heavily into a support level, high effort, but a passive central bank or institution is absorbing every sell order with limit buys, price cannot fall, low result. Conversely, consider low effort with high result. If price moves a massive distance on almost non-existent volume, price is advancing not because of aggressive buying, but due to a total absence of liquidity on the order book. This move is structurally fragile and vulnerable to sharp, immediate reversals. Let's walk through a real market case study. Observe this 5-minute chart of the E-mini S&P 500 futures at 9:30 a.m. Eastern during the U.S. cash open. Price aggressively sells off for 3 consecutive candles, approaching a key daily support level. The third candle shows an enormous spike in volume, over 300% of the moving average. This represents maximum effort. However, look at the candle body. Despite the massive volume surge, the price spread shrinks drastically, closing in the middle of its range. Retail traders see the heavy red volume and sell short, expecting a breakdown. Smart money sees high effort with zero downward result. Institutional passive buy limit orders are systematically absorbing the panicking retail sellers. Within 2 candles, the market prints an aggressive bullish reversal, trapping late shorts. If you master the mental model of effort versus result, you stop reacting to what price looks like and start understanding what the market is actually doing. Part 3. Volume patterns. Stopping volume and buying climax. Now that you understand the mechanics of effort versus result, we can transition from theoretical concepts to actionable chart patterns. Institutions leave unmistakable structural fingerprints at major market tops and bottoms. These are not arbitrary patterns like head and shoulders or double bottoms. They are order flow events driven by institutional necessity. The 2 most critical climax patterns you must master are stopping volume and the buying climax. First, let's explore stopping volume, institutional absorption at bottoms. Stopping volume occurs during an active downtrend. Its purpose is simple: to halt downward momentum through massive passive absorption. Here's the precise sequence of events. Price is falling rapidly. Fear dominates retail traders, triggering panic market sell orders, stop-loss hits, and forced liquidation. Next, a widespread down candle forms, accompanied by ultra-high, anomalous volume, often the highest volume spike of the session or week. Despite the overwhelming flood of aggressive market sell orders, price refuses to expand lower. Instead, it forms a long lower wick and closes near the upper portion of its range. Why does this happen? Smart money cannot build a massive long position without liquidity. The panic selling of retail traders provides that liquidity. Smart money places massive passive limit buy orders directly in the path of the falling price, stepping in as the counterparty to every sell order. The heavy volume reflects the massive execution of contracts. The failure of price to drop further reflects that supply has been fully absorbed. Second, let me introduce the buying climax, institutional distribution at tops. The buying climax is the exact inverse of stopping volume, marking the end of a bull market or strong uptrend. Here is the operational breakdown. Price undergoes a prolonged or accelerating markup phase. Good news headlines break, FOMO, fear of missing out, reaches a peak, and retail traders aggressively buy the breakout. Suddenly, an unusually large, bullish candle expands violently upward on extreme, off-the-charts volume. To the untrained eye, this looks like ultimate strength. To an institutional trader, it is a liquidation event. Smart money uses this surge of aggressive retail buying liquidity to offload their massive accumulated long positions. They dump their inventory into the hands of enthusiastic retail buyers. Despite the extreme volume, effort, price stalls, forms an upper wick, or fails to follow through in the subsequent candles. Result: supply has officially overwhelmed demand. Let's analyze a real-world case study on the NASDAQ 100 futures, NQ. During a major earnings release week, NQ pushes into a historic high resistance level. Price expands $250 higher in a single hourly bar on the largest volume surge seen in 3 months. Retail traders flock in, convinced price is heading to new highs. However, examine the structural details. The candle closes off its highs, leaving a heavy upper tail, and the next bar fails to make a higher high, printing a narrow range on sustained high volume. This was a classic buying climax. Institutions unloaded thousands of contracts into retail market buy orders. 2 sessions later, without institutional buying support, price collapsed $600 to the downside. When you see extreme volume at trend extended levels, do not chase. Recognize it for what it is, the transfer of assets from weak hands to strong hands. Part 4. Volume Patterns. Volume Divergence and Failed Breakouts. While climatic events like stopping volume represent dramatic structural shifts, trend reversals often develop subtly over time. To catch structural tops and bottoms before the rest of the market notices, you must understand volume divergence and the order flow mechanics of failed breakouts. Let's examine volume divergence, trend exhaustion. Volume divergence occurs when price action and volume participation move in opposite directions. It is the clearest indicator of a weakening trend. In bearish volume divergence, price continues to make higher highs, but each successive swing up occurs on progressively lower volume. What is this telling you? The price is moving higher not because institutions are aggressively buying, but simply because sell-side liquidity is momentarily sparse. As buyer participation dries up, the trend is running on empty tanks. It requires only a small wave of institutional selling to initiate a sharp collapse. In bullish volume divergence, price continues to make lower lows, but the downward momentum is accompanied by declining sell volume. Aggressive sellers are running out of inventory. The downtrend is losing its structural integrity. Next, consider failed breakouts, institutional liquidity sweeps. Retail traders are taught to buy breakouts above key resistance levels or sell breakdowns below support levels. Institutions exploit this predictable behavior to generate liquidity for their own positions. Here's how a volume-validated failed breakout unfolds. Price consolidates under a well-defined resistance level that everyone on Wall Street is watching. Then comes the liquidity sweep. Price punches above the resistance line. Retail breakout traders rush in with market buy orders, and existing short sellers get stopped out, which also triggers buy orders. Finally, the volume trap occurs in 2 ways. Under Type A, low volume fakeout, price breaks out on unusually low volume, proving smart money is not backing the move and causing price to quickly drop back into the range. Under Type B, heavy volume absorption, price breaks out on massive volume, but closes right back inside the range as a long upper tail because institutions use the breakout liquidity to dump massive sell orders into the buying surge. Let's examine a live market case study. Observe this 4-hour chart of the S&P 500 ETF, SPY. Over a 2-week period, SPY makes 3 distinct higher highs. Look closely at the volume profile beneath each swing high. Swing high 1 shows heavy institutional volume, 100 million shares. Swing high 2 sees price move $4 higher, but volume drops to 65 million shares. Swing high 3 marginally punches above previous highs, but volume completely drops off to 35 million shares. This was textbook bearish volume divergence. On the final swing, price attempted a breakout above the $500 key psych level on negligible volume. Within 48 hours, aggressive market sellers stepped in, forcing a 4% market pullback. Traders who bought the price breakout were wiped out. Traders who tracked the volume divergence saw the structural collapse coming days in advance. Part 5. Advanced order flow and institutional footprints. Standard vertical volume bars tell you when trading activity occurred. But to see where value is being accepted or rejected, you must add structural horizontal dimensions to your analysis. This brings us to 2 essential institutional metrics, volume profile and VWAP, volume weighted average price. Let's break down volume profile architecture. Volume profile plots total contracts traded at specific price levels rather than over time. It exposes the true structural balance of the market through three core metrics. The point of control, POC, is the single price level where the highest amount of volume was executed during a specific period, acting as an institutional magnet. The value area, VA, is the price range where 70% of the total session volume took place, representing fair value agreed upon by both buyers and sellers. Low volume nodes, LVN, are price levels with minimal executed volume, representing areas of extreme imbalance where price moves swiftly because minimal liquidity opposed the move. When price trades outside the value area, it is in price discovery. If it re-enters the value area, it almost always seeks the point of control. Now let's examine VWAP, the institutional benchmark. VWAP calculates the true average price of a security weighted by total volume. Institutional algorithms and desk traders use VWAP as their primary benchmark for execution quality. If a pension fund needs to buy $500 million worth of stock, buying below VWAP is considered a high-value entry. Buying above VWAP is penalizing because it forces them to pay above the volume-weighted average. Because smart money executes around VWAP, its line acts as dynamic institutional support and resistance throughout the session. Let's analyze a real institutional execution setup combining both tools. Look at this 5-minute chart of the E-mini S and P 500, ES. During the morning session, the market rallies away from the value area. At 1 p.m., price begins to pull back sharply toward the daily point of control, POC, which coincides exactly with the first standard deviation VWAP band. As price touches this confluence zone, volume spikes dramatically on a narrow range candle, high effort, low result. Institutional passive buy limit orders absorb the pullback liquidity, and price violently bounces off the POC and VWAP level, resuming the primary trend. When horizontal volume profile levels align with dynamic VWAP metrics, you are looking at institutional entry zones with high probabilistic edge. Part 6. Trade execution and practical playbooks. Understanding volume theory is useless without a systematic framework for risk execution. You cannot trade on intuition alone. You need precise, repeatable playbooks. Let's convert market structure, effort versus result, and volume footprints into 2 institutional trade setups with clear risk parameters. Playbook 1. The institutional absorption long. This setup captures high probability trend reversals at major support zones using stopping volume. Step 1. The trigger. Price approaches a key daily support or lower value area low, VAL. A wide down candle prints on ultra-high volume, at least 200% above the 20-period average, but closes off its lows, signaling stopping volume. Step 2. The retest confirmation. Do not buy the initial spike. Wait for price to retest the low of the stopping volume candle. The retest candle must show significantly lower volume, proving that aggressive selling pressure has been completely exhausted. Step 3. Entry and risk parameters. Enter long on the close of the first bullish confirmation candle following the low volume retest. Place your stop loss strictly below the lowest wick of the stopping volume structure, giving price 2 to 3 ticks of breathing room. Target 1 is the session VWAP. Target 2 is the top of the value area high, VAH, or point of control, POC. Playbook 2. The liquidity sweep short. This setup targets trapped retail buyers at key resistance levels during a buying climax or failed breakout. Step 1. The trap. Price pushes above a key resistance level or daily high. Look for a strong surge in volume as retail breakout orders trigger. Step 2. The structural rejection. Price fails to hold above the level and closes back inside the consolidation range, leaving a long upper wick. This confirms institutional absorption and distribution. Step 3. Entry and risk parameters. Enter short as soon as a candle closes back inside the previous value range. Place your stop loss 2 to 3 ticks above the high of the breakout wick. Target 1 is the point of control, POC. Target 2 is the opposing value area low, VAL. Let's review an execution case study on NVIDIA, NVDA. NVDA pushes past $1,000 resistance on the market open with massive volume. Within 15 minutes, price forms a heavy upper tail and closes back below $1,000, a classic liquidity sweep. A short entry is triggered at $996 with a stop loss at $1,005, just above the sweep high. Price cleanly slides back down toward the daily point of control at $968. Risk, $9 per share. Reward, $28 per share. That is a 3.1 to 1 risk-to-reward ratio, backed entirely by institutional order flow, not retail guesswork. Part 7. Conclusion and the Master Execution Checklist. Volume analysis is not a magic system or a holy grail indicator. It is a lens that allows you to see the true reality of market mechanics, the continuous interaction between buyers, sellers, and institutional liquidity. When you trade price alone, you are trading shadows. When you integrate volume, you are trading the actual substance driving those shadows. To ensure you execute these concepts systematically, without falling into emotional retail traps, run through this 5-point checklist before entering every single trade. First, context check. Are you trading at a key structural level, daily support/resistance, value area high/low, or VWAP? Never trade volume anomalies in the middle of nowhere. Second, effort versus result verification. Does the candle spread match the volume size? If volume is high but price progress is small, identify who is absorbing the flow. Third, institutional footprint identification. Has the market printed an explicit structural pattern? Look for stopping volume at bottoms, a buying climax at tops, or a low volume retest following a sweep. Fourth, liquidity trap confirmation. Are retail traders currently trapped? Verify whether the breakout is backed by genuine institutional volume, or if it's a low-volume, artificial push into liquidity. Fifth, asymmetric risk to reward. Is your stop loss placed beyond the institutional absorption wick? Does your profit target offer at least a 1 to 2.5 or 1 to 3 risk to reward ratio, targeting the point of control, POC? The financial markets are designed to transfer wealth from the uneducated to the disciplined. Stop chasing lagging indicators. Stop buying low-volume breakouts, and start reading the actual footprints of capital deployment. Study these patterns on past data, test them in real-time execution, and let volume be the final filter for every trade you take. Master the process, manage your risk, and trade with structure.